Thank you, Darshita, for that. We have now joining us Aditya Kondawar, partner and vice president at Complete Circle. Aditya, hi. How do you look at the current market scenario? You have FI selling which is continuing. Yesterday's data on mutual funds shows that there is a slowdown which is coming in with respect to retail money into mutual funds, while SIP flows are at 30,000. The net equity flows have been lower.
Yeah, a very good morning to you and all your viewers. Number one, since September 2024, I think it has been kind of a roller coaster ride for the Indian markets. We always, it's very ironical that when oil goes up, Indian markets fall, but then when the oil cools down, as it has done in the past few weeks, Indian markets don't recover. And obviously, a lot of second and third order effects are being seen in the financial markets. While the SIP book has been stable, the stoppage ratio has also improved. But then, like you said, the net equity inflows have been almost at a 3-year low. Now, obviously, what will happen is that a lot of market participants will look forward to some stability coming in the market, right? And obviously, the biggest elephant in the room is the fact that uh, a lot of semiconductor, AI, or data center plays, the pure plays are not available in the Indian markets. If you look at the global markets, you look at KOSPI, you look at the Taiwan index, you look at the Nasdaq. Majority of the returns that were attributed to the indices were due to a handful of stocks, right? So that representation is not there in India, and the fact that oil prices are still elevated, and there is no particular stability coming in from a geopolitical point of view is what is making investors nervous from my point of view. Unless and until some stability comes, some ceasefire comes, or an agreement is signed, I think investors will be jittery till then.
Aditya, therefore, is it a good time to go out and buy this nervousness maybe? Because good times and good prices don't coincide, right?
Absolutely, Harsh. I think very well said by you. I think when there is blood on the streets, you should go ahead and buy. And Harsh, we have been doing these interviews from a long time, and every interview that we do, I have been saying that you should go and buy. Obviously, the pain period has been quite long. It has been quite elongated. Indian markets are still negative from the peak of September 2024 that we saw. The more the pain, more the reward that you get. I just want to sum it up with that.
Right. But, I think for daily equity market watchers, it's really about timing it to the T. So the question really is, how much more of a downside and how much better a price are you going to get on the ticker? Rudra, just want to get back to you. Are you getting the sense that there is a possibility we could perhaps lose 1,000 points here, get closer to the March lows?
Aisha, I'm not in that camp to sell, nor I'm bearish on this market at current level. At least let the supports at around 22,800 to 23,000 on Nifty break. Then one can wait for a bounce and then go short in this market. Again, you have to understand. I'll give you two technical points. Number one, look at crude oil. Brent crude is between $90 to $102 per barrel for last 1 to 2 weeks. In spite of West Asia crisis, in spite of all the war escalations, now market is not reacting so negative. Second, look at the USD INR. Again, we are in that range of 94 to 96. On top of all the negative news, FII selling, all that, we have again not gone beyond 96 zone. In fact, we are more or less closer to that lower band of 95, 95.30. And both Brent and USD INR is for me telling me that yes, now the peak is more or less done. I don't know whether we get a V-shaped recovery or a U-shaped recovery, but one thing I know is risk reward does not favor you to short at current level. Wherever you get relative strength, be definitely a buyer and have stop loss closer to the 22,800, and this market can turn. For a long time, yes, if you even see the long short ratio, they're above 90% in terms of FII short positioning. So any more positive trigger, or at least now we are not reacting negative for all the news, whatever is happening from West Asia war. And most important, see the relative strength from current level on our market. Asian markets are all down 1.5%, 2%. We are not down 1.5%, 2%. Yesterday, Dow Jones, Nasdaq, everything you see, they were all down 2%. We are not down 2%. opening right now with a gap up or gap down of 2%. So what I'm only trying to tell is Brent is in check in spite of all the negative news. USD INR is in check. It has not gone beyond 96. Brent has not gone beyond $102 per barrel. There is resilience in our market. So I will use all dips as a buying opportunity and no shorting whatsoever.
Okay, quite a conviction call there. No shorting whatsoever. And still has a lot of conviction in the market. But Citi has come out with a note on India, and they have actually lowered the Nifty target from the earlier 27,000 to now 26,000. In fact, it's also flagged off near-term concerns of sustainability of the robust consumer trends seen in Q4. Ashesha is here with highlights from that note, and if they have any stock-specific calls as well, Ashesha.
Well, yes, Citi has come out with its India strategy note, and they've lowered their Nifty target to 26,000 now from 27,000 earlier, and this is on the back of lower multiple that they are now attributing. So they've lowered their Nifty target multiple to 18 times now versus 19 times earlier, because of which their revised target price now stands at 26,000. They say valuations near 5-year, 10 long period average indicates that valuations are pretty reasonable at this point in time versus where they were a couple of years ago. Geopolitics, AI and El Nino risk, these are the three factors that they believe continue to weigh heavy on FII sentiment towards India. But they say a key concern in the near term is likely to be sustainability of robust consumer trends and consumption trends that we have seen in the fourth quarter. Healthy medium-term outlook and low positioning implies that any resolution on West Asia and pause in FII outflows could result in upside on the Nifty 50 and for Indian equity markets as well. Given some sectoral preferences as well, some sector-specific preferences, they continue to remain overweight on financials, telecom, healthcare and utilities, but the key underweight sectors include IT services, staples and metals. In fact, they've also spoken about Hitachi Energy because they've added this counter after their recent initiating coverage report. So several sector-specific ideas that they've shared, but for now, they believe that in the near term, the Nifty target for the next 12 months rather, stands at 26,000 versus 27,000 that they had given earlier.
Thank you, Ashesha. So Citi downgrading the price to earnings for the Indian market to 18 times FY28 from 20 times. So that's earnings impact is basically, almost knocking off the FY27 earnings because of the kind of impact that we could see because of the West Asia crisis and the margin impact. But moving on to textile PLI, we had the government has expanded the textile PLI scheme by approving 22 additional companies under round 3, taking the total number of approved participants to 96. The move strengthens India's push into high value segments. Ravindra joins us with more.
Well, yes, government has approved 22 additional companies under the round 3 of the PLI scheme for textile, taking the total number of approved participants to 96 companies. And with this approval, the cumulative committed investment under the PLI scheme has reached to more than 12,800 crore, highlighting the strong industry interest in expanding India's textile manufacturing capabilities. And the newly approved 22 companies are expected to generate more than 15,500 crore in turnover from the notified textile products, and overall the 96 approved companies are projected to deliver a cumulative turnover of rupees more than 58,200 crore, creating a significant growth runway for the textile. And the scheme continues to focus on high growth segments such as man-made fiber apparels and man-made fiber fabrics and technical textile, which are considered a key sunrise area for the India's textile industry. And this is expected to strengthen India's position in global value-added textile manufacturing and exports. And the expanded PLI coverage is likely to drive fresh capacity creation, employment generation, technology upgradation and higher export. And it will also support long-term demand for the textile machinery, man-made fiber products and technical textile solution. And lastly, if we talk about the key beneficiaries of this PLI scheme, KPR Mill, Gokaldas Export, Arvind Limited, Pearl Global Industry, Vardhaman Textile, Nitin Spinners, and from the technical textile, Garver Technical Fibers and Wellspun Living. These companies could benefit from the improving outlook for the man-made fiber, technical textile and export-oriented textile manufacturing. So back of this scheme, textile stocks can going to be in focus in today's session.
Aditya, curious to know whether textile as a space for investment would excite you after this sizable PLI announced?
Yes, textiles has been one sector that has been hit the hardest ever since tariffs came into play. And if that wasn't enough, when tariffs actually got normalized, the West Asia crisis came into play, and obviously the whole supply chain, the fuel prices, everything just came at once, right? Now I'll just give you some context. Last year India exported some $36 billion worth of merchant of apparel products, right? Now, the thing is, India specializes in man-made fiber and apparels. Now, the PLI that has come in to strengthen the existing segments as well as the technical fiber. Now, someone told me yesterday that India should not just look at capacity expansion but capability expansion as well, and we have seen that playing out in a lot of sectors. Now, take the case of electronics. Everybody used to say that India is just assembling nuts and bolts. But fast forward 2 years, today we have started rolling out our own semiconductors as well, right? That has happened in the case of manufacturing. That has happened in the case of electronics. That has happened in the case of pharma as well, and it will happen in the case of in the case of textiles as well. So number one, we are expanding our capabilities. And number two, what has happened is that India also needs to diversify, not just in terms of geographies, but products as well, right? And that is why I feel, thanks to the 2 year turmoil period that happened with a lot of textile companies, I think from a longer term point of view, I think textile companies give you a good opportunity to enter.
Okay, interesting. That's the take coming in on textile. Aditya, what's the list like, or the preferred list like when it comes to textile, though?
Obviously, I don't want to recommend anything, but then Gokuldas Exports, your PDS, these are some of the leaders that are well diversified in terms of geography and the products and the customer base as well. And one more thing I just wanted to add, if you look at the imports that are done by the US, EU, and UK, cumulatively they import close to $230 billion worth of products every year. So India has a very good opportunity to monetize on the China plus one opportunity, and obviously the Bangladesh opportunity as well, because Bangladesh has actually gone through a very bad phase in terms of the geopolitics, the war, and the changing governments.
All right. IT at all on your list, Aditya?
So Harsh, interestingly, again, if you look at the export data, the services exports have actually grown 12%. Obviously, legacy IT has lagged over here, but then what has actually surprised us is the rise of GCC export revenue and the fact that a lot of GCCs or global capability centers are setting up base in India. In fact, they employ close to 20 lakh people, and maybe in a couple of years they would actually outpace the legacy IT employment in terms of numbers. So definitely, yes. So what is happening in IT is that there has been a lot of news flow. In fact, a new AI model gets released every week, and then investors get jittery. The same companies who were termed as very good cash generating and cash conserving companies are now termed as low growth companies and companies that have missed the bus. Taking a very balanced view, Harsh, what I feel is that IT is here to stay. AI will be just an enabler. When Henry Ford introduced the assembly line, right, a lot of workers went on strike saying that, their jobs will be at risk. But, thanks to the assembly line, lakhs of workers got employment. So I feel that the same will happen in the case of AI, and the same will happen for IT, wherein, a lot of legacy IT companies will also start ramping up their AI business. In fact, Mr. TCS CEO Chandrasekharan ji also said that 100% of their business will be AI enabled in a couple of years, and their annualized run rate for AI revenue is already 2.2.5 or $2.3 billion, something like that. So I see AI as more of an enabler than a disruptive force, to be very honest. But of course, let's see how it plays out, how well India captures this value chain, and yeah, fingers crossed.
Okay, that's that.